Hi, it's Brian from AlphaTrends.net. Today is Saturday, the 18th of July, 2009. I wanted to take a look at these markets a little bit closer. That is, take a larger time perspective and kind of analyze it from that angle. Right now, the S&P 500, as we know, last week we had this widely advertised head and shoulders pattern, which failed to materialize. That is, it broke below this neckline, but then ramped up very quickly. I had mentioned that in last Monday's live analysis that as it was turning right in here, this is where I was getting long right at that point, and the reason for that was because we had seen the higher low and we had seen a higher high here on this short-term time frame, and more particular when it got above that 89 level, that's when it really started to take off. I was outlining that on the 10-minute time frame right in here. So we had seen the higher low and this higher high being taken out as we got above the 5 day moving average. I had gotten long right in here. That morning we had a little bit of a shakeout first. Of course, I didn't hold long, and I held long enough to make a nice profit, but I didn't hold the entire position. In fact, I was trading it most of the week. But we have experienced quite a big rally, and we can look at this rally and say, where does it have the potential to pull back to? We could look at Fibonacci and say a one-third retracement would bring us down to about 91.70, 91 or 90.80 would be a 50% retracement. So those are areas that what normal pullback would bring us to. We had seen in the Nasdaq 8 days up in a row, I guess, is what I read somewhere. But in the S&P 500, when we look at the daily time frame, you can see here we've got this bigger level that we have breached, and this level here was at about 93 bucks a share. So that should be some pretty decent support initially. But when we look at it on an even bigger picture, well, before we get to that, here on the daily time frame, when I look for a real confirmed uptrend, I like to see the 10-day above the 20, above the 50-day moving average. We don't see that quite yet, and to me, that's when it's in a confirmed uptrend, when we make a higher high above that rising 10, 20, and 50-day moving average. So what we need to see is this 10-day moving average cross up through the 20 and the 20 up through the 50. So it leads me to believe that maybe we're going to do a little bit of consolidation in here before we get a break past this level. This is an important level, as we'll see on the weekly time frame, for a couple reasons. One, when we look at the move from the highs of 2007, basically right around 158 down to this low, what I have in here is the Fibonacci level. So a 38% retracement would bring us right up here to about 102, and you can see that's about this level right here as well, where we had seen a little bit of intra-week at least resistance back in November of last year. If we look, beyond that, the 50% retracement's about 113 and then 123, which is this big level where we had broken down from. Let me just clear that all up again and show you this as well, because this appears to be something that's maybe we should start to take a little bit more seriously. We have this market showing this inverse head and shoulders pattern, and again, don't get so carried away with these head and shoulders, because as we had seen this past week, we saw a large failure on the daily time frame. But looking forward, what we might see is if we see that further consolidation in here, maybe we go bang up against that 95, 96. Right now we're neutral on the daily time frame. That is, we're back in this range. But if we go back up and then pull back, make a higher low, and get all those moving averages aligned, then on the weekly time frame, I think that we're going to have a very good chance of breaking out. It doesn't mean it's going to break out. This is what appears to be a very good chance, though. We have the higher low. That higher low occurred right here at the conjunction of the 10, 20, and 30 week moving averages. I'm sorry, the 20, 30, and 40 week moving averages. So the 20 week times 5 days, that's a 100-day moving average. 30 week is the 150-day, and the 40 week is the obviously the 200-day moving average. So we had broken this downtrend line. Breaking downtrend lines doesn't change the trend. We're basically right on it. It looks like we did break it. It's tough to really call it, but we're right on that level. So maybe we back off there a little bit, and then we begin to get moving. Let's take a look at it from a different perspective, and that perspective comes from a volume by price chart. So this chart shows where the biggest volume has occurred. And we're looking at a 2-week time frame over the last, I'm sorry, a weekly time frame. Each one of these bars represents 1 week, and we're looking at 2 weeks worth of data. So we see that downtrend line being broken here. We see the little levels of resistance here at this 95 level, then that 102. And remember, 102 is also a 38% retracement. So that's likely to be a magnet if we do get moving to the upside. That 102 should be our next probable level of significant resistance. But look at this big volume bar down here. This is volume by price. What this means is it shows you horizontally, it represents where the biggest, where the volume occurred. So it shows that the biggest level of volume over the last really over the last 2 years is clearly right around that $90 level. So we survived that shakeout and maybe creating this right shoulder. We survived the shakeout and held this big level here. So we have to look at this as now when the market's above this level, we look at that as a level of support because there's a lot of price memory in that area, and that's where we have a lot of people positioned along, and that's where the shorts are actually are basically losing money. The average short is losing money above that line as well. It's the biggest level of biggest level of volume. If we look at the daily time frame, what I like to look at in here is go back and look at volume weighted average price. So if we go since the move, that is since the March lows right here, the volume weighted average price right down in here. Okay, so it's at about $86. So above that level, the average participant since March is making money. If we take the volume weighted average, let me see, go back to if we take the volume weighted average price since this move right here, that's a very telling thing. So this is the volume weighted average price, and what I do is just simply pick this starting point right here, and you can see the line drawing down below. So the line went lower, and there it is. So that level, since this market broke down right in here, since it broke down, this bear market really experienced the real fastest part of the move. The average participant owns the SPY right around in this 86, 87 level. So that tells me that if the sellers get it back below that level, then the average short seller will be in a winning position. When it's above that level, the short sellers are losing money, the buyers are in control. There's general good feeling associated with approximately the last 9 months of trading in the S&P 500. From this point forward, the average participant is making money if they just bought it, and let's say dollar cost averaged or whatever, the average participant is making money. So that tells me that we've got now again, this going back to this chart, we've got the average, here's where the big volume is, and the average participant is in a winning position. Now I made this blue shade in. These charts are also, I'm going to upload them to Chartly as well. But right here you can see that as the market drops very rapidly through this 120 down to 90 level, there wasn't a lot of trading that occurred there. It created this little vacuum, and what happens is that prior levels of support tend to act as resistance. Resistance acts as support. Well, where is if this market can break out, and it's a lot of ifs here, of course. We've got 95 as a big level. We have to consolidate and then push up through that. Next potential level is 102. Consolidate and push up through that. Then this could be a bigger area. Now, you look at the fundamentals, and the fundamentals stink. Well, bad news comes out at bottoms, and maybe we're at a bottom, maybe we're not, but we have to constantly reassess and change our plan. Last week we had to take, 2 weeks ago, we had to take the possibility of a breakdown of that head and shoulders pattern on the daily time frame seriously. But as it became clear that it was invalidated, from failed moves come fast moves. So right now it's pointing towards a probable continue move higher. Have to be prepared. That's what stops are for. Okay, technical analysis doesn't give you all the answers in advance. It does provide us a map to say say, if it can clear these hurdles, then how much supply is likely to be released here? Well, why does prior support become resistance? Prior support tends to act as resistance because people are trying to get their money back. They're trying to break even. There's not a lot of people that bought in here, so there's not that natural source of supply. There'll be some profit takers, there'll be some short sellers, and that sort of thing. But the shorts could get squeezed really hard through here, and we could have a very violent move higher in the S&P 500 and some of these other markets as well. So that's just a little bit of thinking about these markets, the S&P 500 in particular right now. The 30-minute time frame here again. Let's just take a look here. We will want to see support hold at these different levels, and the Fibonacci and that sort of thing. Those are potential levels where we'll come, if this market begins to pull back, and right now it's not showing any signs of weakness, but when it does, you don't look at those Fibonacci numbers and say, okay, that's where I'm going to buy. You look at the Fibonacci level and you say, okay, here's a level that a lot of people are looking at. So if it pulls back down to this 91.60, I don't want to buy it there. I want to look at shorter term time frames like the 10-minute time frame. So right in here, we didn't want to buy based on a 30-minute time frame. We wanted to drill down and say, okay, it's got the higher low. Now it makes a higher high right in here. It takes that 5-day moving average out. Buyers are in control. You have to be flexible in your analysis. You want to have an overall theme, and if it's not clear, then you stand aside. Early next week, it's likely that we'll probably see some profit taking, some consolidation of this market, but it's starting to look a lot better, overall in the longer term time frames. Don't forget, on Mondays and Wednesdays at 11 a.m., you can find my live analysis at stocktwits.com. And if you're not following me on Twitter, my username is at AlphaTrends. So go ahead and take a look at that, and then you'll know when I'm updating certain positions and charts, and a lot of good free information. Thanks for your time.